The last revision, last subject. Any other subject pending?
No, sir.
No, sir.
No, sir.
Yes. Financial management. Yes. What are the two basic aspects of financial management? Yes.
Control and cost.
Financial management. Costing a lot.
Wealth
Efficient
maximize.
Wealth maximization.
objective. The two basic aspects are efficient procurement of fund and effective utilization of funds. Yes, everybody. Efficient procurement and effective utilization. Even though we have done the basics of first chapter, yes, the other theoretical aspects will be covering it later, but this was definitely covered. Two basic aspects of financial management: effective procurement of funds and efficient utilization of funds, wherein effective procurement of funds is quantity related, whereas efficient utilization is quality related. Yes, everybody. Okay, three important decisions of a finance manager are what? Financing decision, investing decision, and dividend decision. Wherein financing decision is related to your effective procurement of funds, and investment decision is related to efficient utilization of funds. Remember, all of you?
Yes, sir.
Yes.
Yes, sir.
So, and then most important objective is the wealth maximization objective. It is the long-term objective of financial management. Profit maximization is only short-term objective, right? And we focus on long-term always, correct? We focus on the long-term, that is wealth maximization. Is this clear? Yes. More in detail we'll be discussing in the regular classes with respect to your introduction chapter. Just remember this one statement: we cannot create an asset without creating a liability. So if you have to invest somewhere and procure the assets for a project, etc., you need the corresponding source of fund also. Clear, everyone? Yes. So your financing decision is related to the initial chapters we had discussed. All of you remember capital structure, leverages, and first chapter what we discussed was cost of capital. Yes. So this is what we'll be covering in today's class. Okay, cost of capital, capital structure, and leverages. And if time permits, we'll discuss dividends. Otherwise, in the next class, we'll continue with dividends. Okay. So I hope you all have received your R2E material. You have taken printouts of it. Yes. Have you gone through the structure? Let's go through the structure of the material, all of you. Yes. Okay. So you have your index. In that first one, important points I've given about the subject. Then question paper, marks and trend analysis is there, and formula list, all the formulas in one place. One or two formulas, whichever unique ones you come across, and if it is not a part of it, you can add it to it. Okay, everybody. So what I want you to do is from today, every day, 5 minutes you have to spend on this formula list. Every day, irrespective. So starting May, you might not be able to do it in 5 minutes. Okay, but going further, once you're like used to it, definitely within 5 minutes it'll get over. 5 minutes you spend, it's like revising your entire subject, all formulas. Okay. Yes. All right. So just to make it easier, everything is kept in one place there. And then you have your chapters. So here you have theory page number and then your problems page number. And in the end, you have your latest RTP, MTP and suggested answers. One we will be going through just to check the pattern, etc. Okay. So important areas, your problems, right? Become the master of leverage and dividend. I always say this, yes, because almost any paper you check, one question will be there from leverages and dividend, at least 10 to 12 marks, right? Around 10 marks at least comes from these two chapters. Very sweet chapters, small chapters. Solve all problems from these chapters. Weighted average cost of capital, another topic regularly asked in the examination, average 5 to 10 marks. Okay. Ratio analysis, balance sheet construction, computation of ratios, again average 5 to 10 marks. Capital structure. In capital structure, what is most frequently asked is choosing the best financial alternative. This is what is asked. Then model questions are asked. Okay, average 5 to 10. Investment decision and working capital management. There are many topics in these two chapters, right? However, some extremely important topics would be receivables management. Okay, in WCM, again frequently asked, choosing the best, in that also choosing the best credit policy and estimation of working capital. These are frequently asked. See, I'm only talking about probability and the frequency. I'm not telling whether this is important, that is important. Artha aita. Only thing that I will tell for sure important is dividend and leverages. ಇದು ಮಾತ್ರ ನಾನು ಇಂಪಾರ್ಟೆಂಟ್ ಅಂತ ಹೇಳ್ತೀನಿ, ಬೇರೆ ಯಾವುದು ಇಂಪಾರ್ಟೆಂಟ್ ನಾಟ್ ಇಂಪಾರ್ಟೆಂಟ್ ಹೇಳ್ತಾ ಇಲ್ಲ ನಾನು. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? ಆಲ್ ಆಫ್ ಯು ಆರ್ ಯು ಅಂಡರ್ಸ್ಟ್ಯಾಂಡಿಂಗ್? ಐ ಆಮ್ ನಾಟ್ ಸೇಯಿಂಗ್ ದಿಸ್ ಇಸ್ ಇಂಪಾರ್ಟೆಂಟ್. ಇನ್ ಸಿ ಎವ್ರಿಥಿಂಗ್ ಇಸ್ ಇಂಪಾರ್ಟೆಂಟ್, right? But I am just telling you based on the trend what is more frequently asked in the examination. So you can cover these topics first and then move on to the others. What I mean to say is, even by chance, so what happens when you're planning to cover 100% of the syllabus, sometimes 10% gets missed. Okay, it happens. So this cannot form part of the 10%. You got it? This can no case form part of the 10%. Even if, so first of all, you're not supposed to skip any chapter. I don't believe in that concept at all. There will be some very easy, very basic topics in almost all chapters. Investment decision also, simple problems you can solve if you are not comfortable with that chapter. Being my student, you should be comfortable. But say you are not comfortable. Okay, one out of almost the entire class, say one student is not comfortable. Even that student should not skip the chapter. They should do at least the minimum basic problems. Understood? Everybody? Okay? Yes. So choosing best credit policy and estimation of working capital. Then investment decisions, replacement decisions are more frequently asked. Right? Other important topics of investment decisions and WCM. WCM only you can say operating cycle, cash budget, maximum permissible bank finance, factoring, investment decision cells, capital budgeting techniques. Could be NPV, IRR, PB, payback period, and profitability index. Then your theory, right? Again, there are many theory topics. You should never, don't skip the theory. Go through CAPS material and revision material, all theory topics and questions. Artha aita? CAPS material iddidella you should know. Plus what I do in the theory session, which is not yet done, I'll be doing it. Okay. Theory sessions that you should know, and then some repetitive theory topics, right? So main aspects of finance, right? Roles of CFO, all of these things you go through it. Artha aita nimge? This anyway, after a complete theory, you come back and check this. Now you may not understand much. Okay. Ratio analysis, practice all unique type of problems. Right? There are many unique type of problems there. Adan Madi. Practice identifying the starting point in construction of balance sheet type of problems. You should always note down. So which is that starting point? Okay. Keep solving working notes. You will eventually be able to complete the balance sheet. 90% of ratio, just follow the name of the ratio. Only 10% are unique or different. Note them down. WCM, there are many adjustments. Make a note of each unique adjustment, especially in estimation of working capital. Like I said, it is more driven from your cost sheet perspective. Like cost sheet, so many adjustments are there. Similar type of adjustments can come here also. Everybody able to catch me? Yes? Okay. Investment decisions, like I said, many different types of problems like margin costing. 101st problem might be unique, which might be in your examination. However, entire problem may not be different. Just one or two adjustments. Use common sense and understand time value of money. When is T0? That is T0 is normally when the decision is taken. ಅದು ಅರ್ಥ ಮಾಡ್ಕೊಳ್ಳಿ. ವಾಟ್ ಇಸ್ T0 ಅದು ಗೊತ್ತಾಗ್ಬಿಟ್ರೆ then you will not make a mistake. Solve as many sums as possible. Do not have an aversion to this chapter. Most of the problems are very easy. Make note of all different and unique type of problems. There is possibility of MCQ being a case scenario based question. And the possibility it will come from this chapter, I mean to say. From capital budgeting also there is a possibility, right? So capital budgeting and WCM have higher chances of being asked as a case scenario based question. So therefore you cannot think of skipping a particular chapter because it can come as a case scenario question. Case scenario question, if it comes, then you cannot, you will be compulsory, you have to answer it. Go through all the formulae daily, right? 10 to 15 the starting allagutte, ಆಮೇಲೆ 5 minutes ಸಾಕು. ಅರ್ಥ ಆಯ್ತಾ? Afterwards in 5 minutes, once you're used to it, in 5 minutes you'll be able to recall the whole thing. So go through this marks and trend. This is actually supposed to be your job, which I have done it for you. Okay, all the examinations we have written, which are the questions from which topic it has come. Artha agta idya? So here you can see the chapter name: introduction, types of financing, ratio analysis, cost of capital, capital structure, leverages, right? All the chapter names are there. What is the marks that has come in this examination? T is theory, right? And P is problems. Artha aita? Theory and problems. How many marks has come? You can see. And then the average I've given below. You can check here. Average, how much has come. So if you check here, leverages is 6 and dividends. So these two columns. So leverages nodi, right? Average. Sometimes, so theory questions, so then problems ella say you look at the average from the leverage chapter and from your dividend chapter. Okay, so very high marks will come from these chapters for the number of hours you need to spend. Then this is the formula table. Okay, all the formulas in one place is there, so this it will become easier. Make a note of it. Any correction, mostly no corrections will be there. If there is anything, you let me know. Mostly everything is okay. All right. And this is what we discussed in the start, right? So efficient utilization of funds only. You will have utilization of fixed assets and utilization of working capital. Working capital comes in a working capital management chapter. All right. Yes. So your first chapter for discussion is cost of capital. Yes, sit straight, everybody. Keep the videos on. If you're in the class, your video has to be on. Yes. Huh? Yes. Darshan, Shobini, are you there? Shekhar. Videos on. All right. Cost of capital. It is the return expected by the providers of capital. Correct. It is not what the company is paying, rather, what is the expectation of the stakeholders. That is my cost of capital. Remember, all of you? Yes, everybody. Okay. Yes. It is also known as cutoff rate, hurdle rate. Yes, why cutoff rate or hurdle rate? Because that is the minimum return you expect. Yes, the minimum return. See, if you have invested in a project, at least as much as my cost of capital, it should be the return from that project. Otherwise, obviously, see, we all know that the return should be at least equal to my cost. Here, the cost is my cost of capital. All of you understood? Therefore, it is also known as cutoff rate or hurdle rate. What is the significance of cost of capital? It helps in the evaluation of investment options, like I told you. Correct? How? Because based on discounted cash flows, you discount on the cost of capital. And we've learned in investment decision chapter how do you take a decision criteria. So it helps in evaluation of investment options. It helps in financing decision, choosing which should be the source of finance. Right? One of the factors that influences the source of finance or my capital structure is my cost of capital, which will be CRC. Yes, remember all of you? CRC. In the next chapter, we'll be discussing that and designing optimum credit policy. So these are the significance of cost of capital. Is this clear? Yes. Now let us go through the formulas one by one. Sit straight, everybody. Yes. So cost of long-term debt, KD, right? Cost of debt is represented by KD. Irredeemable debt, that means it is not to be repaid. There is no maturity period. KD is equals to I into 1 minus T divided by NP, where I is the interest rate, T is the tax rate, NP is net proceeds. Clear? That is when you minus the flotation cost, you get net proceeds. Issue price minus flotation cost is net proceeds. Redeemable debt, when RV minus NP is not taxable, and this is what is normally asked in the exam. If specifically asked, only then you will assume that it is tax deductible. Otherwise, it is assumed to be not tax deductible. This is also called as approximation method. Formula KD is equals to I into 1 minus T, same as above, right? Plus RV minus NP by N. This N na illi pakkadu khaki. Put it here below this, scratch this and put it here. Okay, RV minus NP by N, the whole divided by RV plus NP by 2. Clear, everybody? Yes. So this is my irredeemable debt formula. Sorry, redeemable debt formula. Okay. Cost of preference share capital, similar to my debt, only thing tax will not be there because preference dividend is not tax deductible. Clear? Yes. So irredeemable preference capital formula is KP is equals to PD by P naught. PD by P naught, again P naught is always net proceeds. Okay, redeemable preference capital, same thing, only 1 minus T won't be there. Preference dividend plus RV minus NP by N, the whole divided by RV plus NP by 2. Right? Very important, N is my remaining life of preference shares, and NP should always be based on my current market price everywhere. Clear, all of you? It is not the issue price, it is the current market price. Understood? NP should always be current market price. Therefore, N is the balanced life and not just the maturity period. Right? Cost of equity, KE. there are five approaches. First one is dividend approach. Constant dividend for perpetuity means you'll use dividend approach d1 by p naught. Clear everybody? Yes. Perpetual and it's assumed to be constant. There is no change. Right? Earnings price approach. Again EPS by p naught. Same thing. Constant earnings and there will be no change and it is forever. Right? Perpetuity. Next. Growth model or Gordon's model. Here there is a growth in the dividends. Right? So there's a growth in the dividends, there's a growth in the earnings. It is not constant. What is constant is the growth rate. Understood? What is constant is the growth rate. So as per Gordon's model, formula is K is equals to D1 by P naught minus F, which is nothing but net proceeds, plus G. Clear? D1 by P naught minus F plus G. This is my Gordon's model, wherein G is equals to B into R. I'm not sure if it's written. If not written, I'll bury there. Right? G is equals to B into R as per growth model. Average model under Dn is equals to D naught into 1 plus G to the power N. Okay. B is the earnings retention rate. Right? And B is nothing but 1 minus dividend payout ratio. Okay. And R is equals to rate of return on funds invested. Clear, everyone? This is my Gordon's model. Next, realized yield approach. Now, when the future is not predictable and you have to place reliance on the past data, then realized yield approach is used, wherein it uses the dividend discount model. That is, the present value of the shares is nothing but the discounted figure of all the dividends. Understood? Right? Discount figure of all the dividends and earnings. Any capital gain is also there, then discounted version of it. All of you understood? So when you use that formula, right? So basically d1 by 1 plus ke to the power n, then d2 divided by 1 plus ke to the power 2. The same thing you do it, right? And then discount it. That's nothing but my realized yield approach. Understood? Yes, everybody, yes or no?
Yes.
Yes,
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 sir.
sir.
Last is my capital asset pricing model approach, wherein the formula is K is equals to RF plus, that is risk-free rate of return, plus beta. What is this beta? Is it my diversifiable risk or non-diversifiable risk?
Non
Systematic risk or non-systematic risk?
Non-diversifiable.
Yes. So obviously diversifiable means why will you consider it? If it cannot be diversified, that is what we consider here. Okay. Beta into RM minus RF. Understood? Right? So RF plus beta into RM minus RF, where R is the, yes, market return, and then your RF is the risk-free rate of return. RM minus RF is the risk premium. Beta into risk premium. Beta is basically your coefficient of systematic risk. Understood? All right. Next comes amortization of bond. Yes, videos on here, everybody. Yes, amortization of bond. Okay, wherein VB is equal to same way, dividend discount model, same thing, present value of all the future cash flows. So C1 by 1 plus KD to the power 1 to the power 2 to the power 3 and so on and so forth. Right, that is my value of bond. So amortization of bond, what happens here is, all of us state, yes, interest is paid on the outstanding balance and each year a part of the principal is repaid. It is not one shot repayment of principal at the end of the maturity period. Rather, the principal is repaid at regular intervals. Disha. Okay? Understood? So, say 1000 rupees is paid at the end of each year. 1000 rupees is paid at the end of each year. Then in the cash flow, you have to consider your principal repayment also. Understood? In the cash flow, to consider principal repayment also. All right. Next. Cost of convertible debentures. Here what happens? Option to either get the debentures redeemed for cash or get specified number of equity shares of the company. That is my cost of convertible debentures. So this is my convertible debenture. How do I find the cost of it? While determining the redemption value. Okay, it is assumed that all the debentures will choose the option which has the higher value, that is beneficial to the holder, right? If cash is more, you go for cash option. If equity is more, you go for equity option. Clear, all of you? So there is no change in the formula. It's the same formula that you have to use only for, that is cost of convertible debenture. So your debt formula only you will use. Only thing is RV will be dependent on, right, which option you go for. Clear, all of you? RV is either cash or equity shares. Equity share ಇಲ್ಲಿ ಏನು ಮಾಡ್ತಾರೆ ಅವರು? Yes, all of you sit straight. What they will do here is, they will give you, say for example, the dividend of the next 10 years. For using that, you have to find out what the growth rate is, and then using dividend model, you can find out the price. So like that, right? You have to find out what is the price, what is P naught, you need to find out. Understood? What is P naught and what will be my future fair value? Understood? Because based on, say, if the see, maturity period is 6 years, then at the end of 6th year, what is my share price? You have to find out that. Got it? Right? What is the formula? Normal formula is d1 by p naught minus f plus g. KE formula is what? D1 by P naught minus F plus G, yes or no? Right? P naught is what? Right? Now, anybody remembers P naught is what? Right? Numerator ಹೋಗುತ್ತಷ್ಟೇ. D1 by KE minus G, ನೆನಪಿದ್ಯಾ? All of you? D1 by KE minus G. So this D1, if I need P naught, it is D1. If I need P6, it will become D?
7.
7. ಅದು ನೆನಪಿಟ್ಕೋಬೇಕು ಅಷ್ಟೇ. ಓಕೆನಾ? That you have to remember. Clear all of you? Yes. Cost of retained earnings, it's similar to KE. All the formulas are the same. Only thing what you remember, there is no flotation cost for retained earnings. Is this clear? There is no flotation cost for retained earnings. So your D by P only, right? Dividend price approach, earning price approach, growth approach. All the place. Put a line here. D1 divided by, put a line and then P naught. D1 by P naught plus G. Okay. There is no flotation cost for your KR. That is the difference between KR and KE. Everything else is same. Right? So these are the different specific cost of capital. These are the specific cost of capital. Next is, how do we find out what is the weighted average cost of capital? Right? So what do we do here is, we take the portion of the debt, cost of debt into portion of debt, cost of equity into portion of equity, that is weight of equity, and then cost of retained earnings into weight of retained earnings, cost of preference share into weight of preference shares, so on and so forth. So that you are basically multiplying the cost of specific cost of capital, whatever the cost is, specific cost of capital multiplied into the respective weight. When you add all of it, you get your weighted average cost of capital. Clear, everybody? Yes. Yes. So it is also called composite cost of capital or overall cost of capital. It is the total combined cost of capital employed together. That is, no, it is calculated by multiplying the specific cost of capital by the weights, that is the proportion of each capital to total capital. To balance financial risk, control over the company and cost of capital, an entity or company doesn't procure entire funds from one source. Rather, funds are procured from multiple sources. Clear, all of you? Why? To balance financial risk and control. This is what we learned in capital structure, correct? You cannot have 100% debt or 100% equity, right? It may not be good for a company. A balanced approach is followed so that financial risk as well as control and cost of capital all are balanced. Weighted average cost of capital, this is the formula. That is what we discussed. Cost of debt into portion of debt, cost of preference share capital into portion of preference capital, that is weight. Then cost of equity capital into weight of equity. The optimum capital is that combination which gives the minimum weighted average cost of capital, because if you remember the formula VF in your capital structure, value of firm is nothing but what? EBIT divided by KO. Lower the KO, higher is the value of the firm. Lower the KO, higher is the value of the firm. Therefore, weighted average cost of capital should be the least. Yes, Sherin, are you there? Correct. So, how do I choose the weight? There are different choices. First is book value, second is market value. Market value is always preferred over book value. Market value is always preferred over book value. The value of equity, so under book value we have, the value of equity will generally not reflect historical asset values, right? As future prospectus of the organization. That is book value if you are taking. However, if you take market value, then it will consider the future value also. ನೆನಪಿದೆಯಾ ನಿಮಗೆ investment decision? I told you that if accepting a particular project increases the net present value of the, but if there is a positive NPV, that means there is a wealth creation by accepting the value. So technically your share price or value of the firm should increase to that extent. ನೆನಪಿದೆಯಾ? Right? The project may not have been executed. It is only been accepted now. It will be executed in future. But however, it will have an impact on the share price. Is this clear? So therefore, if you take market value, you will also consider such future valuation, which is not considered in book value. Only historical asset values are considered. Right? In market value, preferably to use market value weights rather than book value weights for both debt and equity, as market value is more accurate and represents a firm's capital structure. Notes: share price, very important, very important. Share price already incorporates the effect of reserves. When you're taking share price, it already has the reserve value. Do not take KR again. Understood, all of you? You have to split it if required. Anyway, therefore, market value of equity is number of shares into market price. Do not add reserves again. Do not add reserves again. Number of shares into your market price is a combination of your equity and reserves. Book value of equity is equity share capital plus reserves always. Market value of the term loan is nothing but the book value itself. Target weights refer to the optimum weights determined by management. Weighted marginal cost of capital, last concept, it's straight. Marginal cost is the new or incremental cost, right, of the new capital issued by the company. If the new capital is raised in the same proportion as existing capital, that means if the weights of the new capital as well as the old capital is same, then effectively weighted marginal cost of capital and weighted average cost of capital will be the same, because cost of capital is not changing with the change in weights. That's the assumption. Everybody, I hope you were able to recall this chapter. Yes, all of you? All
Yes.
right. Come directly to the RTP. Okay. Let's go to the RTP and then we'll come to the problems. So, $507, I think, is your RTP. This is your batch RTP, right? Vanditaga. It's not written. One second. Yes, September 25. So this is the September 25 RTP. Correct ಆಗಿದೆ. Yes. I'm just going through this chapter. Cost of capital, all of you look at this. Consider the below mentioned statements. I hope you all can see the screen.
Yes, sir.
A debt equity ratio 2:1 indicates that for every 1 unit of equity, the company can raise 2 units of debt. What is the meaning of debt equity ratio? What is 2? What is 1?
One is equity.
One is equity, two is debt.
One is
Two is
equity,
debt.
two is
What they're saying that every 1 unit of equity, company can raise 2 units of debt. Is this true or false?
Yes, sir, true.
Yes.
True.
The cost of floating a debt is greater than the cost of floating an equity.
oh, false.
Cost of debt is more, okay. KD is more than KE or KE is more than KD?
K is more.
K is
is
more
more
than
than
KD.
Correct. So first one is true, second one is false. So D should be the answer, true and false, correct? All right. Next. Yes, look at this now, all of you. Cost of capital. Lavanya Limited wishes to raise additional finance of 20 lakhs. So weighted marginal cost of capital, WMCC. So marginal capital is 20 lakhs for meeting its investment plans. It has 4,20,000 in the form of retained earnings. Okay, already available for investment purposes. Further details are as following. Debt equity means 3:7. Okay, ಇಲ್ಲಿ ಈಗ very simple this is, right? So 20 lakhs is there for this 2 arrow marks. Okay, debt and equity, this is 3 and this is 7, so this will be 6 lakh and 14 lakh. Next, here 2 arrow marks, so retained earnings they've given is how much? 4.2 lakhs. Therefore balance equity to shares is nothing but 9.8 lakh. Understood, everybody? Yes, here also 6 lakh ಇದೆ ಇಲ್ಲಿ 2 arrow marks. They've given up to 3.6 lakh. 3.6 lakh. The rate is 8% before tax and beyond 3.6 lakh. That means how much? 2.4
4.
4.
lakh. It is how much? 12% before tax. So if it is 8% before tax, then after tax is how much? Tax rate of 30%. So into 70% ಮಾಡಬೇಕು. Into 70% you should do. Then based on the weights of 3.6 and 2.4, find out what is my average debt. KD average. Understood all of you? Right? So that becomes KD, then KE is there, and KR. All right. Next, how do I find out KE now? All of you, cost of debt, easy, we found out. KE, which approach? Earnings they've given, dividend payout ratio is given, retained earnings percentage is given, retention ratio this is, okay. Then rate of return on retained earnings is given. Rate of return R is given. Current market price per share is given. What do we use? Which approach for KE?
Growth
Which
model.
approach can we use for KE?
Gordon's model.
Yes, growth approach, correct. Growth. Why? Because they've given retention ratio, right? That is B, as well as my rate of return R. B into R is the growth rate. Clear all of you? So using that we can find out what is it. Okay, so earnings per share is 5. Therefore, dividend is how much? 40% of earnings. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? 2. Now this is my D naught, therefore D1 will be 2 into 1 plus G is what? B into R, that is 0.6 into 0.1. ಏನಾದ್ರು ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ?
Yes, sir.
Yes.
Yes. Yes. Let us look at the answer. So your pattern. So pattern is already done, everybody. This is the pattern. Correct or not?
Yes, sir.
Next, post-tax average cost of additional debt. I told you how to find out the average of the two, 3.6 and 2.4 being the weights, right? And then you find out the after-tax cost of 8% and 12%. Find out the average. That is done. Determine the cost of retained earnings and cost of equity. Both will normally be the same until and unless there is a flotation cost. Have they given any flotation cost? So both can be same. Okay, using my dividend. So growth approach. Compute the overall weighted average after tax cost of additional finance. Simple problem. Yes or no?
Yes.
Yes, look at the answer. So this one is true and false. We got this correct. So 14 lakh, 6 lakh. First two arrow marks I did. Correct. Then 9.8, 4.2, 3.6, 2.4. Is this right or wrong? Done?
Yes, sir.
Determination of post-tax average cost of additional debt. I told you to find out the average. So after-tax cost of 8% and 12% is 0.056, 0.084. That you multiply into the respective weights of 3.6 lakh, 2.4 lakh and divide by 6 lakh. You'll get 6.72 average percentage. Determine the cost of retained earnings and cost of equity. I told you since flotation cost is not there, you can equate the both using growth model D1 by P naught plus G, D naught into 1 plus G by P naught plus G. Right, dividend paid is 40% of EPS rupees 2. I told you this, correct or not? Yes, growth rate is 6%, that is 60% into 10%. Current market price per share is 53. Therefore, KR is equals to T into 1 plus G. Yes, Manoj. What is 2? It is my current dividend, right? 6% is the growth rate. 53 is what? Current market price. Understood? 10%. Overall cost of weighted average cost of capital 14 lakh, 6 lakh, 0.7, 0.3. 10% is the cost of equity. 6.7 is the cost of debt. Multiply and add it, 9.016%. That's it. Right? This is my yes RTP. Let's go through some questions of the revision material. Yes, page number 169 of the revision material. Yes, so Performance Limited has a capital structure that consists of equity share capital, reserves and surplus, bank term loan debentures which are redeemable at a premium of 5% and preference share capital redeemable at a premium of 5%. The coupon rate of debentures is 1.5 times that of this is that equation problem we had done. Okay, this is similar problem is solved in the class. All of you concentrate now. The coupon rate of debentures is 1.5 times that of bank term loan coupon rate, whereas the preference dividend rate is 1.5 times of debentures interest rate. Now, coupon rate of the debenture is how much? Really?
1.5 times bank.
Yes. All right. Ready. So, bank interest rate, can I assume it to be X, everybody?
Yes, sir.
Right? So, the coupon rate of debentures is 1.5 times that of bank term loan. Therefore, interest rate of bank term loan is supposed to be X. Then this becomes 1.5X. Clear, everybody? Yes, no. Then, preference dividend, what have they told? Preference dividend is 1.5 times of debenture interest. So, this is my bank term loan. 1.5X is what?
Debenture interest.
Debenture
Debenture
interest.
interest.
So this is 1.5 times of debenture interest. So 1.5 into 1.5x. Yes, everybody.
Yes, sir.
Right. So 1.5 into 1.5x. 15 square is 225. 2.25x. ಅರ್ಥ ಆಯ್ತಾ ಏನಾದ್ರು? Yes? No?
Yes,
All
sir.
right. Next. What are they given? What else is given? Newer for the bank term loan, debentures and preferences is given 3 years, 5 years, and 7 years respectively. Current book value of the capital structure is as follows: equity share capital, reserve and surplus, bank term loan, debentures, and preference share capital. Tax rate applicable to the company is 25%. Debentures are currently selling at a price of 96, whereas what should we take for the purpose of NP in the formula? Current market price or issue price?
Current
Current market
Original
price.
issue price alla, current issue price and current market price has to be considered. So it is 96, whereas preference shares are currently selling at 102. The equity shares of the company are quoted at 150 per share. Yes, equity shares are quoted at 150 per share. The ongoing P ratio for the shares of uh, Parham Parhans Paramhans Limited is at 6.67 times. Okay. It belongs to a risk class where the overall capitalization and discounting rate of the company is 20%. So KO is already given. You need to equate it and find what X is. Correct? Using the WACC table. Rate of interest on bank term loan and debentures you have to find out. Rate of preference dividend. Weighted average cost of capital using market value weights. And lastly, that's all. These three are the requirements of the question. All of you understood? Yes. Okay. Now, interest rate is X, but this is pre-tax, correct or not? Post-tax would be what? KD of term loan is equals to interest into 1 minus T. Post-tax interest is X into, yes, 1 minus 0.25 is equals to
75.
0.75x. Okay, this is KD. This is KD of what? Of term loan. Next, KD of debentures. Debentures is how many times this thing?
1.5
1.5 times.
Correct. All right. But anyway, formula wise, I into 1 minus T plus RV minus NP by N, the whole divided by RV plus NP by 2. Got it? Yes. Interest is what?
1.5.
Correct. So 1.5 of this KD, so ಇಲ್ಲಿ interest is 1.5x. ಎಲ್ಲಿ ನಾವು ಮಾಡಿದ್ವಲ್ವ ಒಂದು interest we have to find out directly here, all of you. Okay, so bank term loan is 10 lakh. Face value of 100 here, all of you. Face value of 100, right? So is other ಮೇಲೆ interest rate ಎಷ್ಟು? So it will be 1.5x means 150x. Am I right or wrong? Yes. All right. 150x into 1 minus 0.25. ಅರ್ಥ ಆಗ್ತಿದೆ ಏನಾದ್ರು all of you? Yes, Hiranmai, did you understand? Okay. All right. Let me go through the answer. ಅಲ್ಲೇ ನಮ್ಗೆ ಕಾಣಿಸುತ್ತೆ ಈಗ. Calculation of interest on bank term loan and debentures, wherein bank term loan is assumed to be x, for debentures 1.5x, for preference dividend rate 1.5 times of 1.5x, 2.25 times. This is exactly what we did above. Yes or no? Correct. Next, now let's calculate KD term loan, KD debentures and KP preference shares. KD term loan interest into 1 minus t, right? Interest is x, 1 minus t, 0.25, 0.75x. Did we get the same answer? Yes or no? Correct. Then I into 1 minus t plus RB minus NP by n the whole divided by RB plus NP by 2. Redemption value is what? 5% more than the face value given in the question. 100 plus 5%, 105. Net proceeds is issue price or current market price, very important. Okay, so that comes to 96. So 150x, I told you, 1.5 times of my normal interest. So interest is what? Face value into x, everybody. That is, but x is for x is for term loan. I want for debenture. For debenture it is 1.5x. Understood? And if face value is 100 into 1.5x, you have to get 150x. Clear, everybody? Yes, the same thing has come here into 1 minus 0.25 plus RV redemption value 105 minus current market price 96 divided by balance type 5 whole divided by 105 plus 96 by 2. You're getting KD of debentures. This is the formula. Okay, you will not get the complete answer because x is still unknown. Okay, next you do for preference dividend, preference shares, PD plus RV minus NP by n the whole divided by RV plus NP by 2. Right, you did the whole thing. You got KP formula. This is my KP formula. Right, so 3 formulas are there. Okay, next KE is what? P ratio is given as 6.667. I told you KE, when you use my earnings approach, ನೆನಪಿದೆಯಾ all of you? Under earnings approach is nothing but 1 divided by PE. Correct or not? The same thing, 15%. Right, now you substitute here. Right, equity share capital, what is the amount of capital given in the question? All the weights you write. Is this clear, everybody? All the weights. Cost of capital 15% for equity share, same thing for reserves and surplus, retained earnings, bank term loan 0.75. All these 3 equations you write it here, then you multiply it into the respective weights. Okay, you get this equation, this final equation equated with 20% because that is my overall cost of capital. Solve for x, you will get the answer. Right, a 15.86, 23.79, 35.68%. ಅರ್ಥ ಆಯ್ತಾ? Mark this important, all of you. This is an important problem. Now this is using market value weights. Above we did using book value weights. Artha aita? Yes. Suggested answer, latest examination. The following information pertain to CMC Limited. A number of equity shares is 20 lakh. Then book values are given. Market price of equity share, market value, face value, beta coefficient. That means it's known. What you should remember? CAPM model you have to use for KE. Correct? Equity premium and taxation. The company expects that the share prices will rise in future at an average rate of 6% per annum. What is this?
G.
Growth rate, right? The 10% convertible debentures of which 100 each will be converted in 6 years' time. This is my maturity period into equity shares of the company in the ratio of 1:4. 4 equity shares for each debenture. Okay. So first you have to find out what is the market price. That is basically P7 I have to find out. Okay. The market value of 12% bank term loan is at par. Okay, whatever is in the books. You are required to calculate cost of equity share capital by applying capital asset pricing model, cost of convertible debenture by using approximation method, cost of bank term loan, weighted average cost of capital using market value weights. Look at this easy cakewalk question. This is for 7 marks. Okay, nothing, no complication whatsoever. Did you find anything in this problem? Yes, easily. And then Who says FM is not easy? FM is extremely easy. Okay, you guys will make it complicated by keeping an apprehension of the subject. FM is easy. Yes, Manoj.
Yes, sir.
So risk-free rate is what? 4.5% given. RM minus RF is the risk premium of 9%. Beta coefficient is given. Apply the formula, you get the rate. Yes, simple as that. Price of shares after 6 years, I told you P7. You need to. So, yes. The normal, so P7 alla, D7 you have to find out if you're using my dividend model. But here, current market price is given, I suppose. ಇಲ್ಲಿ current market price ಕೊಟ್ಟಿರುವಾಗ, so this is P7 under D7. Okay, if you're using the dividend discount model, then D7 has to be found out for P7. Artha aita? But if you're finding out directly by using the growth rate, for 55 is given, 6% is the growth rate given of the share price. Very important, you have to see what is the growth rate. They have written that the share prices will rise in future at an average rate of 6%. Therefore, directly on the share price, you can apply. Is this clear? Had they given earnings is growing or dividend is growing, then you cannot apply on the share price. Okay, so 55 into 1.06 to the power 6, 78.018 is my future value. So they are saying that you get 4 equity shares for every 1 debenture. So into 4, this is my redemption value. Cash value would be what? Cash value would be the face value itself. Net proceeds is 108. That is the current market value. Okay, N is 6. KD is equals to interest into 1 minus T. The whole formula you have to apply. Substitute the figures, right? And then you'll get the answer. KD is 119.52%. Cost of bank term loan, KD into 1 minus T, you get 8.4%. Then find out what the weighted average cost of capital is. Okay? Right? So again, this is a simple formula. What you have to note down is one more problem of cum interest and ex interest. Okay, I had done that in the class, all of you. And then interpolation, everybody knows. Interpolation, L plus NPV of L divided by NPV of L minus H into H minus L. Nenpidia, Gottidia, all of you. Yes, you use the same interpolation technique, right? If it is at L rate, if NPV is L, okay? NPV is L. At high rate, NPV would be H, which is more normally NPVL or NPVH. NPVL is more than NPVH or NPVH is more than NPL. What is the correct answer?
NPV. NPV of H.
L is more or H is more?
Else.
L.
L. NPV of L is always more, right? Rate of higher rate is more, but NPV of lower rate is more. Clear, all of you? So at L it is NPVL, at H it is NPVH. We want it to be 0, correct? So for a change of L minus H, NPV has changed by absolute terms. You need to add both and then do it. NPDya, this logic. Yes? Yes, no?
Yes, sir.
Yes,
Yes.
sir.
So next one is the marginal cost of capital with adjustment that you have to be careful and note it down. Okay. So what is the additional equity issue you can do without changing the capital structure? Yes, that is based on the debt equity ratio that's present there. You need to use that and do it. The case scenario based MCQ. All of you go through this one. Yes. Okay. All right. Yes, so these are normal problems. Okay, anyway, just note it down. The X interest and cum interest problem, you have to do it. Without fail, I've done it in the class also. Okay? Other miss ಮಾಡಬೇಡಿ because that was asked once or twice in the examination earlier.
November 22.
November 22 now. Okay. This is the one. Illide. Okay. All of you look at this. So 39 is X dividend. Preference share is 18 cum dividend. Okay. So what do we do? You should always cum dividend means including dividend. You should always exclude it. So 18 minus 2, 16 is considered. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ all of you. So if it's already X, then X you will continue as it is because X only ಬೇಕಾಗಿರೋದು. Got it? Everyone? That one problem. And then margin cost of capital. How much can be spent for capital investment before sale of new equity shares? This is the important adjustment which is done in the class also. Okay. How much can be done before? So what do we do here? You take the proportion, right? So 15 retained earnings is there, 50% of EPS into number of outstanding shares. Total retained earnings is 62,500. Then debt equity ratio would have been given. They would have told you it is 20:80 or whatever they've given. Yes. So they told you 62,500 is 80% of capital. Therefore 100% is 78,125. So until 78,125 you can use without making any, without issuing any additional shares or debt. ಅರ್ಥ ಆಯ್ತಾ ನಿಮಗೆ all of you? So retained earnings we already have. All of you got it? So how much of capital we can use without issuing new equity shares? Got it? So this retained earnings divided by 80% will give you the 100% portion of it. So corresponding debt you can take. Got it? So 78,125 is what you can spend. So these adjustments are done in the class. That are important. All of you done? Understood? All right. The next chapter again. Next chapter, lot of theoretical concepts are covered in the next chapter, that is capital structure. Okay. Now, cost of capital told you what will be the cost of my capital. How do I calculate the specific cost of capital, being debt, equity, preference shares, debentures, right, bond, etc., right, retained earnings, etc. Capital structure basically is going to answer the question, what should be the ratio between my debt and equity, how my capital should be structured, how much of equity I should have, how much of debt I should have. That is what is my capital structure, which is related to my financing decision. Correct, everybody? So what is my optimum capital structure? It refers to that combination of capital of debt and equity, right, where my KO is the least. Where my KO is the least, or in other words, the value of the firm is the highest. Value of firm is highest. Understood, everybody? Yes, no? Right? So, again, there are various factors that will determine what should be the capital structure, CRC. Right? Cost of capital is important. Risk element is important, as well as control is important. Understood? All of you? So, CRC will determine what should be the optimum capital structure. Right? So you cannot have very high debt. Why? Because if there is a lot of debt, risk is more. Right? At the same time, you cannot keep issuing equity shares because you're losing control. Right? Cost of debt will be lower than my cost of equity. Right? All of these factors you have to consider for determining what should be the cost of capital. Now, determining what should be my optimum capital structure. Capital structure theories, there are different theories. Broad categories are relevance theory and irrelevance theory. Everybody sit straight. Yes. Relevance and irrelevance theories. Today I think I have to leave you in time because after this you have a audit session, correct?
Yes.
Whatever it. So I'll leave you in time. Definitely. Don't worry. 8 o'clock 8 o'clock ಬಿಡ್ತೀನಿ. And then we'll continue in tomorrow's session. Alright, sit straight. Relevance theory means what? Net income approach, right? So relevance theory is what? It means the capital structure decisions are relevant. It is going to influence the value of the firm, right? Irrelevance theory means they say that, boss, it doesn't matter what my capital structure decision is, irrespective of the capital structure decision, it is not going to impact the value of the firm. Gauri Shankar, sit straight, right? So relevance theory examples, right? First one is this is what I started off with, net income approach. Net income approach says that all my capital structure decisions are relevant. What is the net income approach? It says that with the increase in the value of debt, all of us straight, with the increase in the value of debt, KD and KE remaining constant, KD and KE remaining constant, what happens with the increase in the value of debt? WD is increasing and WE automatically will reduce, because remember, in my capital structure theories, the assumption is that one will replace the other. Correct. So with the increase in the value of debt, WE keeps reducing. KD is more than KE for the reasons you know. Why? Because risk of debt is lesser than cost of equity, as well as because the presence of tax. Clear over tax advantage on debt. Because of these two reasons, KD is less than KE. Because KD is less than KE, with the increase in the weight of debt, KO will come down. Net income approach says more will be the debt, KO will be lesser. Is this clear, everyone? Right? This is my net income approach. Next we learned was my net operating income approach, NOI approach. NOI approach, it says that. So remember, net income approach, I told you one terminology in the class, ಅದನ್ನ ಈಗ ಹೇಳಕ್ಕಿಲ್ಲ ಲೈಫ್ ಕ್ಲಾಸಲ್ಲಿ ನೆನ್ಪಿಟ್ಕೊಳ್ಳಿ. ಗೊತ್ತಾಯ್ತಾ what I told? ನೆನ್ಪಿದ್ಯಾ? ಬರ್ಕೊಂಡಿದ್ದೀರಾ ತಾನೆ? Does not make sense at all. Yes, Varshita? Common sense man cannot accept that logic, right? How much ever debt you keep taking, it is cost of capital, overall cost of capital of the company will keep coming down. No, it never happens like that, because that is answered by the second. When the weight of debt keeps increasing, equity share stakeholders will start perceiving higher risk, and you know that risk is directly proportionate to the expectation. If the risk increases, equity shareholders will start expecting higher capital. Now what is happening in net operating income approach? With the increase in the weight of debt, with the increase in the weight of debt, KD remaining constant. In net operating income approach, KD is constant. With the increase in the weight of debt, KO should ideally come down as per net income approach. However, as per NOI, it will be balanced off with the increase in KE because of the higher perceived risk. Understood? These two forces will cancel out each other, because of which they say, as per NOI approach, capital structure decisions are irrelevant. Right? Your model is a copycat of the same thing. Only thing is they are proving it by arbitrage mechanism. That is my model. Right? So model without tax also is an irrelevance theory. Therefore model with tax is a relevance theory. Right? Model with tax, so you say if tax is there, then it will have an impact. Clear, all of you? Right? So same formula we'll be using for model with tax. Only thing is we'll be minusing the tax advantage on debt from the value of the firm. Clear? Yes. Next comes traditional approach. Traditional approach says that capital structure decisions are relevant up to a certain point. It is not going to impact increase in the weight of debt up to a certain point, but beyond a certain level, KE and KD both will start increasing, as both of them will start perceiving higher risk, because of which KO will increase. Therefore, what is optimum capital structure? Gauri Shankar, at that point where the KO is the least, that combination of debt and equity where KO is the least is my optimum capital structure. Traditional model doesn't answer exactly how. They just plot it on a graph and say when it is the least, that is what it is. Clear, all of you? So these are your capital structure theories. Let us now go through the revision material quickly, and then we'll go through the RTP. Yes. So financing decisions, capital structure, it is a combination of capital from different sources of finance. Capital structure refers to the combination of debt and equity, right, which a company uses to finance its long-term operations. It's a combination of capital, of debt and equity. Optimum capital structure, it is that capital structure where value is maximum. Optimum CS refers that mix of debt and equity, which KO is minimum, since lower KO, higher value of firm. At optimum capital structure, right, an optimum capital structure is a financial plan having an appropriate debt equity mix which minimizes the overall cost of capital and maximizes the value of the firm or market price of the share, thereby maximizing shareholders' wealth. My ultimate objective always is maximization of shareholders' wealth or wealth maximization. Capital structure theories, relevance theories, irrelevance theories, right? CS decisions are relevant here. It will impact the value of the firm. Here it will not impact. This is what we learned now. Net income approach, traditional approach, model with tax, NOI, and model without tax. Other theories are pecking order theory and trade-off theory. We'll discuss it below. Right? In 1, 2, and 3, there is no tax. Right? The assumption is that there is no tax. That is, in net income approach, in traditional approach, in NOI approach, and in model, all these four, there is no tax. In model with tax is present. Right? Some common assumptions are there are only two sources of capital, debt and equity. That's all. The total capital employed remains constant always, right? Increase in equity will be used to redeem debts and vice versa. EBIT remains constant, very important. Yes, EBIT remains constant. There are no corporate taxes or transaction costs. There is no growth. It is perpetual and it will be constant. There are no retained earnings. Entire profits are paid as dividend. That is why there is no growth. ನೆನಪಿದ್ರೆ ನಿಮಗೆ, okay? Therefore, DPR is 100% perpetual life and business risk is constant. These are the assumptions. Value of the firm is EBIT by KO. Net income by KE is value of equity. Value of debt is V minus S or interest by KD. Okay. V is equals to S plus T. Net income approach, I told you. According to this theory, the capital structure of a firm affects the value of the firm. That is, capital structure decisions are relevant. Okay. Yes. Correct, Ranjita? Capital structure decisions are relevant. Therefore, if the financial leverage of firm increases, that is, increase in the weight of debt, KO will come down because KD and KE is constant. Okay. Next, net operating income approach. According to this theory, the value of the firm is unaffected by the capital structure. Right? Whatever may be the degree of leverage, the total value of the firm remains constant. Therefore, if the financial leverage of a firm increases, right, KO remains constant. Either the very simple is, right, you can write here your KO is equals to WD into KD plus WE into KE. Net operating income approach ಅಲ್ಲಿ ಏನಾಗುತ್ತೆ, right, with KD will remain constant. However, with the increase in your weight of debt, right, weight of equity will come down, whereas KE also will go up. KE will go up, right? Both these forces will cancel each other, because of which KO will remain constant. KD is less than KE always. Traditional approach, up to a certain point there will not be a change, but beyond that both KE and KD will increase, because of which KO will also increase. Right. Model, I told you it is similar to NOI approach. However, they prove it by way of arbitrage mechanism. That is, it is similar to NOI approach. However, model provided a behavioral or operational justification through arbitrage process. What is arbitrage process? It is a process by which a similar product having different prices in different markets at the same time are brought to equilibrium. Why? You buy at a market where it is, lower price, and sell at a market where it is higher price, and you'll make risk less profit. This is the temporary phase through which you can make profits till equilibrium is reached. They say capital structure decisions are irrelevant, right? So summary of your model, all of you concentrate. Without tax, if you're moving from a levered company to unlevered company, when will you move from levered to unlevered? If the levered company valuation is lesser than unlevered company valuation, right? You sell something that is cheap and you buy you sell something that is costly and you buy something that is cheap. So levered firm, if you're moving from a levered firm to an unlevered firm, right? So value of the unlevered firm will be lesser and value of levered firm would be more. That is why you will sell levered firm and you'll buy unlevered firm. Okay. Now, levered firm means it has both equity as well as debt. So 10% of the equity you're selling. Okay. However, the debt portion of the levered company is replaced with the 10% personal debt. Okay. You take a 10% of that as a personal debt borrowed, that you invest in the unlevered firm. Now there are two approaches here. One is income approach, increase in income. Other is savings in investment approach. Increase in income approach andre entire amount is invested. If you're going for savings in investment approach in my, then 10% is invested. Right? So I repeat, if you're moving from a levered firm to an unlevered firm, right? That means you are selling this and you're buying this, you always sell what? Something that is cheap or overpriced. When it is overpriced, right? High valuation, you sell it. Something that is low valuation, you buy it. Right? When that happens, 10% equity you sell, 10% personal debt is borrowed. This you invest in unlevered firm. If it is increase in income approach, entire amount is invested. If it's savings in investment approach, then only 10% is invested. Unlevered to levered, 10% equity. Unlevered means there is no debt. Right? In the unlevered company, only equity is there. So 10% equity is sold. You invest in the levered firm. Again, increase in income approach, entire amount is invested. Right? Savings in investment approach. This entire amount is invested in both debt plus equity. All of you. Same way, savings in investment approach. Invest 10% in total value, that is debt plus equity. This is the summary of my model without tax. Clear, all of you? Good. Next, model 1963 with tax. Okay. When there is tax, there is tax shield. Therefore, VL should be greater than VU. Okay. What is the formula? So value of debt is 100 lakh and tax rate is 20%. Andre, tax advantage on debt is DT. Shortcut formula for tax advantage is DT. VL is equals to VU plus DT. That's all. So VU is nothing but EBIT into 1 minus T divided by KO star. KO star is nothing but overall cost of capital of an unlevered firm. Therefore, KEU is nothing but, right, the KE of that company, because there is no KD. KD is not there at all. Artha aita nimge? However, as per model, model without tax, all of you, what is model without tax prakara, KO will be equal to KEU. KO of the levered firm will be equal to KEU. Yes or no? Because both the firms' valuation is same. Is this clear? Right? Is this clear? However, if there is tax, then it will not be same. So you assume that there is no tax, right? Find out what is the value of the unlevered firm, right? Then to that you add the tax advantage on debt, you'll get the value of levered firm as per model with tax. KO of the levered firm is EBIT into 1 minus T divided by VL, right? KE of the levered firm PAT by S. So you can also use the formula K is equal to KO star plus KO star minus KD into D by S into 1 minus T. This is very similar to my ROI ROE relationship formula. ನಿಮ್ಗೆ ಗೊತ್ತಿದ್ರೆ ನೆನಪಿದ್ರೆ. Yes. Alright. This why information asymmetry should come below this. Pecking order theory. Pecking order theory. Why does it happen? Because of information asymmetry, everyone does not have equal access to all information. Insiders, that is those who are in the management and closer to the management, have better access to information when compared to the external world, because of which the information asymmetry happens. According to this, the order of financing is retained earnings. If you use retained earnings, there is no signal you're sending out. If you take debt, you send a positive signal because it shows that you have confidence in the project. If you go for external equity, you send negative signal, no confidence. Trade-off theory. This is very similar to your model with tax. So the formula is same. VL is equals to VU plus tax advantage debt. However, you're minusing cost of financial distress, right? Because with the increase in the debt, there is a possibility of liquidation, etc. Liquidity issues will be there. That is called financial distress. This B value is subtracted. Right? ROI ROE relationship, ROE, return on equity, is nothing but return on investment plus return on investment minus interest rate into debt by equity, the whole into 1 minus T. When ROI is, this is what is important from examination perspective. If ROI is greater than I, then debt is preferred, obviously, right? Because of the leverage impact. Right? If ROI is greater than I, and if you have more debt, then because of leverage impact, ROE will be very high. Nanpedia, all of you? Yes? Alright. If ROI is less than I, then equity is preferred. ROI is equals to I, then indifference. EBIT EPS relationship, where market price per share is PE of P multiple of EPS. Financial break-even point, then correct Madi, all of you. Correct this. It will be interest plus PD divided by 1 minus T, 1 plus 1 minus T, because preference dividend is post-tax. I want the pre-tax, 1 minus T. This one, idukku parala. Indifference point, it is that point, right, where EPS under both alternatives is same. It is that point of EBIT. At what level of EBIT will the EPS under two alternatives be same? That is my indifference point. Okay, so EBIT star minus interest 1 into 1 minus T by number of equity shares. Same way on the RHS you do, you equate it and find what EBIT star is. That will be my indifference point. Theory point, overcapitalization is a situation where the firm has more capital than its need, or in other words, assets are worth less than its issued share capital and earnings are insufficient to pay dividend and interest. Overcapitalization ge asset turnover ratio example kottide in the class, go through it. Undercapitalization, it is reverse of overcapitalization. Actual capitalization is lower than my proper capitalization as warranted by its earning capacity. ಇದಕ್ಕೆ entire theory of overcapitalization and undercapitalization is important. All the points that come under this topic is important. You have to go through. Is this clear? So this summarizes my capital structure chapter. Let us quickly go to the RTP. Yes. It's page number 512. Yes. So financing decision, capital structure. ABC Limited is planning to raise 50 lakh for a major expansion project. The firm is evaluating three financing options. I told you, with choosing the best financial alternative is one of the most frequently asked examination question when it comes to capital structure, more than your NOI, NI, and all of that. Artha aita? Yes. Okay. So first one is equity financing only, 100% equity. This is okay. In all these, what you have to understand always is the number of shares you have to know, okay, in different alternatives, as well as my interest, right? Wherever preference dividend is there, then preference dividend. Issuing new shares at rupees 10 each, issue price is 10, but flotation cost is 9.5, therefore net proceeds is
9.5.
9.5, right? Because flotation cost is 50 paisa. Existing UT shares is 10 lakh, okay. Market price per share is 20, okay. Next, debt financing only, 100% debt, right? Borrow 50 lakh at 12% interest. Flotation cost on debt is 2% of the face value, right? I need 50 lakh, therefore should I rate 50 lakh or something more than 50 lakh because flotation cost has to be given. Ready? I have to raise more alva. Artha ಆಗ್ತಾ ಇದೆಯಾ all of you? Because flotation cost has to be given, I need 50 lakh in my hand. So 50 lakh by 0.98 is what I have to raise. The lender imposes a debt covenant limiting the interest coverage ratio EBIT by interest to a minimum of 2.5. That means minimum 2.5 should be there. Interest coverage ratio. Okay. We will calculate that. Mix of equity and debt financing. Right. So 25 lakh through equity, 25 lakh through debt. However, yes, additional information. Project EBIT is 15 lakh annually. Corporate tax rate is 30%. Existing shares is 10 lakh. Risk-free rate is 6%. Market return 14%. Equity beta 1.2. You can calculate KE using this. From the above information, calculate the net proceeds from each financing method after flotation cost and determine the number of new shares issued in option 1 and option 3. For debt options, check if the interest coverage ratio complies with the covenant of minimum 2.5. Calculate EPS under each option. Calculate the weighted average cost of capital under each option. Consider the impact of rotation cost on capital raised. Advise which financing option is best from both an EPS and WAC perspective. Clear all of you? Weighted average cost of capital both has to be considered. Let us look at the answer. Yes. Calculation of net proceeds after flotation cost and number of equity shares. This is what I do. Normally, even if they're not asked, this will be my first working note. I've done this in the class. Working note is always number of shares and interest. Okay. So net proceeds, I told you 9.5, 50 lakh you need, 50 lakh by 9.5, 5 lakh 26,316 shares. Is this clear, all of you? Yes. Debt option, flotation cost is 2%. So if you raise 50 lakh, you'll get only 49 lakh. Therefore, no, you cannot do. What you do is 50 lakh divided by 0.98. This is what I told you. 51 lakh, 2041 has to be raised. Either mere interest is 12% of this 6 lakh 12,245. Right? When you go for a mix, 25 lakh by 9.5, 25 lakh by 2%, sorry, 98%, 25 lakh 51,020. Interest on this 3 lakh 6,122. Right? Calculation of interest coverage ratio, all of you under all options. If you go for debt option, then EBIT by interest, you have EBIT is 15 lakh. This is the interest 2.45, which is the less than 2.5, correct? Therefore, it is failing. I cannot go for 100% debt option. Is this clear? Then when I'm checking for mix of equity and debt, in that the interest is 3 lakh 6,000. Other than I'm getting 4.9, which is greater than 2.5. Therefore, this passes. Understood? Calculation of earnings per share, EBIT minus interest into 1 minus T divided by total shares. Equity optionally, there is no interest. Entire income is my net income. So 15 lakh into 1 minus 0.30, 10 lakh 50,000 plus. Right? Here you have got it. Yeah. So number of shares is 5,26,316. Everybody? Total shares would be 10 lakh when you go for equity option plus 5 lakh 26. This is my existing shares. Arthaita, all of you. 10 lakh is my existing shares. 5 lakh 26,316 is my new shares. 15 lakh 26,316. My income, net income is 10 lakh 50. So when I divide it, I get 0.688. Okay. That option, right? What will be the EPS if I go for debt option? 15 lakh minus interest, all of you concentrate, into 1 minus 0.30. Net income is 6 lakh 21. Total shares is 10 lakh. 0.621, which is more than, sorry, that is also less one. EPS is also less and interest coverage ratio is failed. So this is in all cases bad. Clear, all of you? Debt option. Mix option, 3 lakh 6,122. If you calculate the EPS of this, I'm getting 0.662. So EPS is higher for mix option, right, than debt. However, equity option EPS is higher than even mix option. Next comes calculation of weighted average cost of capital, cost of equity using CAPM, RF plus beta into RM minus RF. When you apply it, you will get 15.6. Clear? For equity option, it will be 15.6. For debt option, entire 12% into 1 minus tax rate, 8.4% is my debt option. For mix option, calculate weight of debt into weight of equity. So what is the weight of debt and equity? All of you concentrate. It is very important. Why? Because normally you would have done a mistake of 0.5, 0.5, which is wrong. Why? What is happening? Debt is more because of flotation cost. Nenpidiya? Right? So 25 lakh and 25 lakh 51,020. Other the equity, weights you find out. So cost of equity using CAPM is 15.6. KD after tax is 8.4. Multiply into the respective weights, you get 11.96. Okay. So the respective rates are 11.96, 8.4, 15.6. 8.4 I cannot choose because interest coverage ratio is less than 2.5. Is this clear? All of you. Right? Next option is between equity and mix. Right? Which is better, equity or mix? Considering both EPS and WACC, which is better? Big idea.
Mix.
Mix is obviously better because weighted average cost of capital is very less when compared to this. Arthaita. EPS difference is only 0.0 something. Arthagtide nimge. Hence, recommended option is mixed financing as it complies with the debt covenant, has higher EPS than debt option and lower WACC than equity option. So this is better. Anyone? Any doubts in this? Okay. Clear? Everybody? Yes, we'll just glance through some of the other questions of capital structure. This is what is important. In some cases, they would have not given you the revised revenue. Okay. Anyway, I'll. Okay, there is one problem. I've done it in the class. Also, is there in one of the previous examination questions. Concentrate, all of you. So, whenever a new project is accepted, what happens? The revenue should increase. Correct or not? Revenue will increase, and additional revenue will be there, and you calculate the cost of capital and all accordingly. However, in some problems, it would not have been given. Right, so you will not be able to compute the KO, etc. What you assume is, had my if my KO is consistent, then what would be the value? ಅದನ್ನ ನಾವು ರೇಷಿಯೋ ತಗೊಂಡು ಮಾಡ್ತೀವಿ. ಅದೊಂದು ಪ್ರಾಬ್ಲಮ್ ನಾವು ಮಾಡಿದೀನಿ ಕ್ಲಾಸಲ್ಲಿ, ಅದನ್ನ ನೋಡ್ಕೊಳ್ಳಿ. ಅರ್ಥ ಆಯ್ತಾ? ಕ್ಯಾಪಿಟಲ್ ಎಂಪ್ಲಾಯ್ಡ್. So on the new capital also, if the same return is there, what will be the revised EBIT? ಅರ್ಥ ಆಯ್ತಾ? ಆ ರಿವೈಸ್ಡ್ EBIT ಅಲ್ಲಿ minus the new interest, minus the dividend, and then divide by number of shares, and EPS is arrived. Always remember, you have to choose a financial alternative based on the alternative that gives you higher market price per share always. Right, if the question is silent and they have not given you PE ratios, then you assume that the PE is constant and you choose a higher EPS. If PE is given, always it is higher MPS, because EPS is profit maximization, MPS is wealth maximization. It should always be based on wealth maximization. Artha aita? This one point I wanted to cover specifically in this financial alternative. Then financial break-even point related problems ಮಾಡಿ. Financial break-even point, right? And then your capital structure, your NOI, NI and all, not much. You will find lot of practical problems, examination problems. What you find is basically your model problems. Got it, everybody? Model problems very frequently asked in the examination. Adanna go through ಮಾಡಿ. Okay. Adರಲ್ಲಿ main thing what you have to note down is model without tax. It assumes that what the value of two firms will be same if the risk is same. If the risk is same, value will be same. If value is same, KO is same. Right? Even if it is an equity firm, KE of that will become KE of this firm. Artha aita? However, if you're doing arbitrage, then it may not be same. It may not be same, because of which there will be arbitrage possibility. Artha agta idea? It may not, if there is arbitrage. If it is not an arbitrage problem, then you have to assume it to be same. Clear? If they have asked you to calculate, right, there are different type of problems. Please understand. One is arbitrage related problems. Arbitrage related problems, it need not be as per theory. Because it's not as per theory, you have an arbitrage possibility. If it is exactly matching as per theory, then you will not have arbitrage possibility. Artha agta idea? Yes. So identify what is the question asking you. Are they telling you to prove the arbitrage mechanism? Right? Are they asking you to prove the model? Then yes, you have to go by invest 10%, etc. etc. Artha aita? And then show what the arbitrage gain is. Clear, all of you? That is separate. However, if they've just told you to find out the balancing figure, then equate the values of the firms into it. Right? That is the key. Okay. And arbitrage mechanism ಅಲ್ಲಿ please follow the step by step approach what I've done in the class. Exact ಅದೇ step, ಅದೇ wordings. I've given you the exact wordings, Roman number 1, 2, 3, 4. ಹಂಗೆ ಮಾಡಿ. Okay. So these were the important points of capital structure related problems. Okay. Yeah, go through all the problems that is there in the revision material. Yes, that's it. Okay. We'll just discuss a little bit theory of leverages and then I'll conclude today's class. Yes, what is leverage? Yes, it is the influence or power of one financial variable over other related financial variable. Everybody sit straight. It is the influence or power of one financial variable over other related financial variable. Clear all of you? Yes. So how do we term it as? So if there are two variables x and y, if there are two variables x and y, and we are calculating the impact of change in x on y, we are calculating the impact of, so sales is changing. What is the impact on EPS? So sales is x, EPS is y. Understood? Sales is changing. What is the impact on EPS? Correct? Sales is x, EPS is y. We term this as leverage of y with x, leverage of EPS with sales. Got it? Leverage of EPS with leverage of y with x. So how do we write it? Change in x, a change in y divided by change in x. There are three major types of leverages: operating leverage, financial leverage, and combined leverage. Sit straight. What is operating leverage? Basically, if you know your income statement, right? Sales until your EBIT is basically your operating leverage. Clear? So here major risk that is being operating leverage measures your operating risk. What is your operating risk? Your fixed cost, operating fixed cost. Understood? Then comes your financial leverage. Basically from your EBIT until your EPS is your financial leverage. Here, what is the financial risk? It is the interest component or any other fixed commitment of financial charges. That is your commitment charges. Clear, all of you? Basic your interest cost. Right? Combined leverage from sales till my EPS, the entire thing is your combined leverage. Right? Very simple formula, way to remember the formula for operating leverage. Remember, operating risk is measured by operating leverage. Operating risk is my operating fixed cost. One above fixed cost, one below fixed cost. Yes, formula is
Contribution by EBIT.
contribution by EBIT for operating leverage. For financial leverage, what is the formula? One above interest, one below interest.
EBIT divided by
EBIT divided by EBT. Understood? In many of the leverage formulas problems, your starting point is normally which formula? Starting point is normally which formula? Anybody remembers? Financial
EBIT.
leverage. Yes, EBIT by EBT, because EBT you can write as EBIT minus interest. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ? Right. So if the financial leverage would have been normally given EBIT by EBIT minus interest ಮಾಡಿದ್ರೆ ಆಗೋಯ್ತಲ್ಲ. Normally that is my starting point. Interest they would have given, EBIT is not a known figure, and financial leverage would have been given. That way you can find what EBIT is. Once you find out EBIT, you can find out the entire income statement. Clear? Right? Again, degree of operating leverage is also equal to percentage change in EBIT divided by percentage change in sales. Always remember, sales is my x, so y upon x. Understood? Y here is EBIT. I told you until EBIT is operating leverage, so percentage change in EBIT divided by percentage change in sales. All of you clear? Right? Next, your financial leverage, percentage change in EPS divided by percentage change in EBIT. Only the numerator will become denominator here. Understood? Percentage change in EPS divided by percentage change in EBIT, the entire thing overall, if you want to do it, percentage change in EPS divided by percentage change in sales. Right? And one above, one below formula we know. So these are the formulas of my financial leverage. Another important thing that we must note is the relationship of margin of safety with degree of operating leverage. Yes. So what is the relationship? Margin of safety is nothing but EBIT divided by contribution. That is the inverse relationship between degree of operating leverage and margin of safety, because margin of your operating leverage formula is what?
Contribution by
Contribution by
Contribution by
EBIT. Here
EBIT.
this is EBIT by contribution. We have done the derivation in the class. Okay, so they're inversely related. Artha aita all of you? Right? So these are the formulas of my operating leverage, financial leverage, and combined leverage. The entire discussion of theoretical discussion is done. Go through the theory and come to tomorrow's session. We'll go through some of the problems of leverages and then we'll be going through the other chapters. Okay, that's it. Thank you, everybody. Bye, all of you.
Sir,
Sir.
session
Yes.
is till 8:30.
8:30 na?
Yes.
Yes, sir.
8:15 ಅದು ಸರ್ ನನಗೆ ಹೇಳಿದ ನೆನಪಿತ್ತು. ಸಾರಿ 1 ನಿಮಿಷ. Oh, 8:30. Okay. I thought 8:15 you have audit valuation. Audit valuation is at what time?
8:30.
8:30.
Oh, exact 8:30. Oh, okay. Okay, fine. Then great. Then we'll finish leverages. ನಾನು unnecessarily I thought. ನನಗೆ sir had sent me an audio note. I didn't see. I forgot to see her message. 8:15 ತನಕ 8 o'clock 6:30 to 8 I'll keep and then 8:15 I thought they will have. Okay, fine. But anyway, I will leave you at least 5-10 minutes before. I don't 8:30ಗೆ ಮತ್ತೆ ಶಾರ್ಪ್ 8:30 ಅಂದ್ರೆ ನನಗೆ ಹೊಡೆದಾಕ್ಬಿಡ್ತೀರಾ. ಸೊ ಥ್ಯಾಂಕ್ ಯು ಫಸ್ಟ್ ಆಫ್ ಆಲ್. ಇಲ್ಲಂದ್ರೆ ಬ್ಲಂಡರ್ ಆಗ್ತೈತೆ ಈಗ. ಥ್ಯಾಂಕ್ ಯು. ಲಾಸ್ಟ್ ಮಿನಿಟ್ ರಿವಿಷನ್ ಇಂದ ಸ್ವಲ್ಪ ಕನ್ಫ್ಯೂಷನ್ ನನ್ನ ಸೈಡಿಂದ ಆಗಿದೆ, ಸಾರಿ. ಓಕೆ, ಲೆಟ್ ಅಸ್ ಕಂಟಿನ್ಯೂ ವಿತ್ ದ ಪ್ರಾಬ್ಲಮ್ಸ್. ಗುಡ್ ಓನ್ಲಿ ಬಿಕಾಸ್ ಅದರ್ವೈಸ್ ಟುಮಾರೋ ಐ ಹ್ಯಾಡ್ ಟು ರಶ್. ಸೊ ಗುಡ್, ಐ ಹ್ಯಾವ್ ಟೈಮ್. ನಾಳೆ ಇಲ್ಲಾಂದ್ರೆ ರೆಸ್ಟ್ ಮಾಡಬೇಕಿತ್ತು. ಸೊ fine, we'll have a comfortable time we have. Let us go through the leverages problems. Okay, RTP again. RTP, all of you open RTP. So yes, page number I think 513, financing decision leverages. Kavna, are you there? Yes. So X Limited and Y Limited are two mid-sized companies operating in the same competitive industry. Both companies have recently undergone a financial performance review to assess their operational efficiency, cost structure, and operational financial risk. All stories. You as a financial analyst have been provided with selective financial indicators and are required to draw insights and comparison based on the leverage analysis and income statement reconstruction. That means you have to prepare the income statement based on the information given. The management of X Limited has disclosed that the company is currently operating with a margin of safety ratio of 0.1667. What is the MOS ratio versus my degree of operating leverage? They're inversely related. Gottalva? Right. In contrast, Y Limited has a margin of safety that is twice as high as that of X Limited. Okay. Both companies maintain a financial leverage of 3. Their variable cost ratios are 60% for X Limited and 50% for Y Limited. Okay. In terms of financing cost, X Limited incurs an annual interest expense of 30,000. I told you, if interest is there and if you know financial leverage, what can you find out? EBIT we can find out. Very good. Y Limited, however, incurs an interest cost that is 300% higher than X Limited. Both companies are subject to corporate tax of 30%, which affects their net profitability after interest and taxes. You are required to prepare income statement for both the companies and identify the company which is better placed with reasons based on the leverages. So very simple. Yes, all of you. So first EBIT you find out. Okay, EBIT you can find out, all of you. Okay, less interest we already know, and then EBT we get. Clear? Now what is using MOS, the margin of safety ratio, I can find out what is degree of operating leverage. Correct? Yes or no, everybody? Degree of operating leverage I know. EBIT I know. What I can find out? Contribution I can find out. Contribution I know. EBIT I know. What I can find out? Fixed cost I can find out. Very good. Yes, all of you. Next, they've also given that the variable cost ratio is 60%. That means if VC is 60, what is 40? PVR is 40%. Allah. If PVR is 40%, contribution I know, what I can find out?
Total.
Sales. Have we reconstructed the entire income statement? Yes or no? From EBT, obviously you remove the from earnings before tax and then less tax. You get earnings after tax. Simple. Have we reconstructed the entire income statement? ಹೇಳ್ಬೇಕು.
Yes.
Yes. Shall we go through it? Yes, look at this now. I told you the starting point is always financial leverage. EBIT by EBIT minus interest, 30,000 is known. Therefore, I found out EBIT is 45,000. Then 1 minus margin of safety. 1 divided by margin of safety is 6 operating leverage. Then using operating leverage and EBIT, I found out what contribution is 2.6 lakhs, 2.7 lakh. Using that, I found out, using PV ratio, I found out sales. Correct or not? This was the exact discussion we had, all of you. Then contribution minus EBIT is my fixed cost. Same thing I do for company Y. Same thing I do for company Y, and entire income statement is reconstructed. Did you all understand this? Here, everybody?
Yes.
Huh? What is, however, important is the comment. Right? Comment based on leverage. Company Y is better than company X for the following reasons. Capacity of Y to meet interest liability is same as that of company X. Right? Both of them have the same interest coverage ratio. However, company Y has lesser financial risk, as the total risk, that is business and financial, of the company Y is lower. Combined leverage of X is 18 and Y is 9. Artha aita all of you. Right? Did you understand? How did they compute the combined leverage? Is there a network issue? No.
No.
Clear? So did you understand how to calculate combined leverage? Yes or no?
Yes.
Contribution and EV80, you can find out combined leverage. Right? For both, you can find out combined leverage. And since you know that lower the leverage, lowers the risk. However, interest coverage ratio is same. Therefore, the same. Right? Y is better than X. Clear, all of you? That comment is important. You always miss out on the comment and you lose marks. 90% students do not comment. Even in the examiner's comment later on, once the paper is done, they give examiner's comment and then go through Madi. Last exam, no, you go through. You'll understand what all the mistakes students do. In that, one of the comment always is that students are missing to give some, conclusion or summary, both in costing as well as FM. Right? These comments you don't miss, you lose marks by missing on the comments. Clear, everybody? Right? So leverages, almost all of them are very similar. Right? You have to reconstruct the income statement and then use these ratios. Artha aita? All of you, right? More or less, most of them are very similar type. Then go through ಮಾಡಿ solve ಮಾಡಿ. Okay? All right. So then, think and discuss what I wanted also in the start to discuss dividends. Okay, so we will conclude even dividend chapter in the next class. Comfortably, we'll be doing only capital budgeting, working capital management, and ratio analysis. These 3 chapters today, 4 chapters tomorrow. We'll be doing those chapters. Okay, all right. Yes, so dividend decisions. Third important decision, right? First is your financing, then investment, and then dividend decisions. Clear, everybody? Now, in dividend decisions, right? The decision is how much of dividend should be distributed. First of all, whether I should distribute the dividends or not. Second, how much of the dividend should be distributed, right? How much of it should be retained, right? Whether the decision of the dividends is going to impact my valuation of the company or not. All of these are the questions. Artha aita? Should the dividend payout ratio should be constant? Should it change over year and year? Right? Should there be a growth? All of these are answered in the dividend decision chapter. Okay. Dividend is part of the profits distributed to the shareholders after paying my taxes, right? So once you pay taxes, then preference dividend, and then finally you pay your equity dividend. Clear, everybody? Right? So the profit after tax can either be distributed as dividend or it can be retained. Now the question is, should it be retained or distributed? Right? As per Walter's model and Gordon's model, etc., they say that if the company is growing, and has good returns, that is ROI, is more than my expectation of the stakeholders, then they say let the company retain. Let the company retain because it will add wealth to the organization. This is, I'm talking about principles. We'll come to the formulas and everything will go to the material. Everybody understood? Yes. So it is a long-term financing decision, right? One of the financing option is always equity. Equity can be raised through issue of new shares or generated through retained earnings. If I generate through retained earnings, then it is okay. Dividend will not change. However, if I go for new equity share, then dividend will come down. Yes, no. Retained earnings in finance ಮಾಡಿದ್ರೆ number of shares will remain same because of which dividend will go up next year. Say assume, Gauri Shankar, I assume that whatever is my retained earnings is reinvested. So when it is reinvested, my EBIT has to go up. So from last year, this year my EBIT has gone up. If EBIT has gone up and number of shares is same, then dividend should go up. However, if I had gone for new equity shares, issue of equity shares, then what will come? Dividend will come. Artha aita. Right? So these are the discussions we'll have in different decisions. Chapter, Kavana, are you there? Yes, Shreyas Gowda, Darshan. Yes, Mamta, Maulyashree. Any videos of all of you. Dividend decisions. Right? Dividend is the part of the profits. Is a part of profits distributed to the shareholders. PAT can either be distributed as dividend or can be retained in the business. Dividend policy of a firm is governed by long-term financing decisions and wealth maximization decision. Okay, long-term financing decisions. One of the financing options is equity. Okay, equity can be raised through issue of shares or generated through retained earnings. This is what I discussed just now. Right? Decisions to be taken care are whether organization has opportunities in hand to invest in the amount of profit if retained. Right? See, it should retain only if it has opportunities. Otherwise, there's no point of retention. Clear, all of you? Better to distribute the dividends. And whether ROI will be higher than KE, that is the expectation of shareholders. This is extremely important. Wealth maximization decisions regarding the amount of dividend to be distributed, shareholders will give higher value to near dividends than capital gains. This is very important again. Yes. Why? Chinmay, what do they say? That a bird in hand is better than two in the bush. Nenpidya? Correct or not? So, two near dividends, they prefer what is they're getting now rather than what they'll get in the future. Payment of dividend influences the market price. Use of retained earnings to finance profitable investment increases the future EPS. Right? Therefore, a proper balance has to be struck between both approaches. Clear, all of you? One approach is that the shareholders want it more, and the other is what? If you have retained earnings, then I can invest it and get better earnings for future. Okay, earnings and growth, relationship between earnings and growth. I have discussed this very in detail with an example in the class. Okay, with an example in the class, why B into R will result into growth anta. Right? B is my retention ratio. Rate is the rate of return on investment. Please go through that example which I've done in the class when I was doing your cost of capital, earnings model, Ali, and growth model. And the growth model that B into R, when first time I introduced, I'd given an explanation and an example. Go through that again. Determinants of dividend decisions, availability of funds, cost of capital, capital structure, stock price, investment opportunities in hand, internal rate of return, trend of the industry, expectation of the shareholders, legal constraints like Section 123 and taxation. Practical considerations, formulation of dividend policy depends upon the following: whether there should be a stable pattern, underline that, stable pattern of dividend over the years, or whether the company should treat each dividend decision separately. Right? Should I have a fixed dividend payout policy of 40% every year? Right? Or each year should I take the decision separately? That is also practical consideration. Theories of dividend, relevance theory. It means that dividend decisions are relevant. It will impact the share price. It will impact the share price. Irrelevance is obviously Modiglani and Miller theory. Under relevance, you have Walter's model and Gordon's model. Gordon's model we already discussed in cost of capital. The new one what we're discussing now is Walter's model. Walter's model, all investment proposals are financed to retained earnings only. Okay, this is one of the major assumptions. That is why they say growth. is impacted by the dividend decision. If you dividend everything, if you distribute everything, then there'll be no growth. If you retain, then there'll be growth. That is because you assume that retained earnings is the only source of finance. R and KE are constant. Okay. Perfect capital markets, no tax, no flotation cost, and perpetual life. Formula is share price is equals to dividend, that is D plus R by K into E minus D, where R is the rate of investment divided by K into E minus D, the whole divided by KE. Clear all of you? This is the formula for Walter's model. This model shows how dividends can be used to maximize the shareholders' wealth. Right? Retentions influence stock prices only through their effect on future dividends. This model emphasizes two factors which influence the MPS. Two factors are what? One of them you can see in the formula, dividend per share. Second is the relationship between ROI and KE. That is why you have R by KE, Arthaita, into E minus D. E is the earnings, D is the dividend. E minus D is retained earnings. Retained earnings mele R is basically what you're getting return on the retained earnings. Right? E minus D is retained earnings. Retained earnings into R is the rate of investment on the retained earnings. Divide by KE, you're getting the share price value. Okay. This model explains why MPS of growing companies are high even though dividends are low. Right? MPS depends on quantum of dividend and profitable opportunities. Very important, profitable opportunities available in investing the retained earnings. Okay. Now this is common for both for models, Walter as well as Gordon. When R is greater than KE, right? Rate of return on the investment is more than KE. Better to retain everything. Correlation between size of dividend and MPS negative. Optimum dividend payout ratio 0. R is equal to K, doesn't matter. R is less than K, 100%. Distribute everything. Your expectation is less than what the shareholders want. You distribute everything. Right? Simple to understand, easy to compute. It can envisage different possible MPS in different situations. Disadvantages, it does not consider all factors, ignores factors such as taxation. Determining K is difficult. Gordon's model. Firm is an all equity firm, no debt. The same assumption. RR will remain constant. R is constant. KE will constant. Retention ratio will remain constant. That is why you can apply B into R. Otherwise you cannot. Growth rate is B into R is also constant as B and R is constant. KE is greater than G. That is the formula. Otherwise KE minus G will not work. Right? Here the formula is very simple. Right? D1 by K minus G, same formula, but you expand it. D1, you can also write it earnings into 1 minus B, all of you with me? Yes. E into 1 minus B divided by K minus G. G you expand it as B into R. That's all. The same formula this is. Right? Again, the conclusion is same. R is greater than K, then don't pay out any dividend. If R is less than K, then pay out everything. Clear all of you? Next one, model. Right? So model, all these factors, they are all similar. Okay, constant, same assumptions are there. Okay. Formula is very simple. P naught is equals to P1 plus D1 divided by 1 plus KE. All of you concentrate. P1 is dependent on future dividends. Correct? If you have retained, if you are... Yes, concentrate. P naught is equals to P1 plus D1 divided by 1 plus KE. Clear all of you? What is the share price at the end of first year? What is the dividend at the end of first year? Discount it today, you get P naught. Clear all of you? Yes. Now, P1 again will be dependent on my future dividends. Correct or not? Now, if my dividend of the current year is more, if the dividend of the current year is more, all of you concentrate. If D1 is more, obviously it will have a higher impact on P naught. Correct or not? If D1 is more, P naught will become more. Yes. However, if D1 is more, then funds required for investment, right? Funds required for investment is say 100 lakhs and dividend distributed is say 60 lakhs. Then retained earnings is 40 lakhs. Therefore, balance 60 lakhs, what will I do? Sorry, retained earnings is 40 Allah. If funds required is 100 lakh, if retained earnings is say 60 lakhs, right? I have retained 60 lakhs, then 40 lakhs I have to go for fresh issue. Clear all of you? Because I told you equity is the only source of finance. Understood? I am going for fresh issue, then what happens? Number of shares will increase. If number of shares increases, the future dividends will come down. Arthakta idea? Therefore, both these forces will cancel out each other and because of which P naught will remain constant. This is the whole crux of MM model. They say that your dividend decisions are irrelevant. It is not going to impact the share price. So P naught is equals to P1 plus D1 divided by 1 plus KE. P naught is the price at the beginning. P1 is the price at the end of year 1. D1 is the price at the dividend at the end of year 1. The whole divided by 1 plus KE. Next, you have to calculate M. You have to calculate M. What is M? Right? That is basically the number of shares to be issued. Clear, all of you? Number of shares to be issued to raise the funds. That's the formula is very simple. Funds required by share price. Funds required is investment minus open bracket earnings minus dividends. Earnings minus dividend is retained earnings. Artha ಆಗ್ತಾ ಇದೆಯಾ? So I will open it. ನೋಡಿದ್ರೆ ಅರ್ಥ ಆಗುತ್ತೆ better. Yes. So NP naught I told you. Before that, P naught is P1 plus D1 by 1 plus KE. All of you clear? Yes. Next, NP naught is before NP naught M. This N alla M ಮಾಡಿ ಇದನ್ನು. Make this as M. M. This is M. M is number of shares to be issued to raise the funds. Funds required is I minus retained earnings. Because retained earnings I already have. What is short is I minus retained earnings divided by P1. Clear, all of you? That will give me M. Therefore, NP naught is equals to P1 into N plus M minus I plus E whole divided by 1 plus KE. What should we do to prove MM model? You do one scenario when dividend is distributed, one scenario when dividend is not distributed. In both scenarios, the value of the company will be same. Is this clear? That is my MM model. You have to prove. It's a theorem. You need to prove it. It's a theorem. You need to prove it. Right? Graham and Dodd model. It says that your dividend is more important than earnings. Right? It is 3 times given more weightage than earnings. So formula is multiplier into D plus E by 3. Is this clear? D plus E by 3. Lintner's model, it says that your dividend should be stable. It should not fluctuate a lot. Therefore, formula is D1 is equals to D naught plus EPS into target payout ratio, say 40%. EPS into target, however, minus D naught is the increase in dividend. Multiply that with adjustment factor. Right? So D1 is equals to D naught plus EPS into target payout ratio minus D naught into adjustment factor. This is the formula. Clear? Right? Yes. So these are the theoretical points. Forms of dividend. You have cash dividend and bonus shares or stock dividend is there. Advantages of stock dividend. What are the limitations is given? Right? Yes. So policy of paying fixed dividend per share and its continuation increases total cash dividend. Okay, of the shareholders in future. If you have a fixed dividend per share. Right? Conservation of cash for meeting profitable investment opportunities, cash deficiency and restrictions imposed by lenders to pay cash dividend. What is the limitations of stock dividend? This is the advantages of stock dividend. They're saying cash is preserved, right? There's a conservation of cash if stock dividend, that is bonus issue, is done. ಅರ್ಥ ಆಗ್ತಿದೆ ನಿಮಗೆ all of you, right? Limitations of stock dividend does not affect wealth of the shareholders. Yeah, you all know this bonus issue does not affect you, right? 1:1 is balanced out by the share price. Yes or no? Sir would have explained this in accounts also. Stock dividends are more costly to administer than cash dividends. Okay. Stock split, basically one split now, one share when you split it, that is my stock split. So what is the advantage and disadvantage of that? Go through it. So this is basically the summary of my dividend chapter. Let's go to the RTP. Yes. So in the month of April of the current financial year, shares of PQR Limited were sold for rupees 1,570 per share. This is my market price, right? So the a long-term earnings growth rate G is 8% is anticipated. PQR Limited paid dividend. When you pay, what is it? Paid andre D not a D1 na?
D naught.
D naught. Okay. Calculate the rate of return an investor can expect to earn, assuming that the dividends are expected to grow along with earnings at 8% per annum in perpetuity. Right? So they are asking you what? G ಇದು B into R. ಅರ್ಥ ಆಯ್ತಾ ನಿಮಗೆ? G ಇದು B into R ಇದ್ರೆ that rate they're asking. Got it? All of you, yes, no? right? It is expected that PQR Limited will earn about 10% on retained earnings. So this is my earning and shall retain 60% of the earnings. In this case, state whether there should be any change in the growth rate and cost of equity, right? Again, a simple problem. Just all of you look at this. So, according to dividend discount model approach, the firm's expected or required rate of return is computed as below. K is equals to D1 by P0 plus G, correct? So, this D1, I told you, this is my 25 is paid dividend into 1 plus G divided by my market price plus G gives me KE. Is this clear, all of you? That is my required return on equity. Any doubts here? Very simple. Yes or no? Yes.
Yes.
Next, the next question is what I told you. Sorry, ನಾನು ಆವಾಗ interchange ಮಾಡಿದೆ ಓದುವಾಗ. I wanted to tell the next one is basically about the G is equals to B into R. The rate of return on retained earnings is 10% and retention ratio is 60%. Therefore, new growth rate will be as follows. G is equals to B into R, 10 into 60, that is 6%. Right? Accordingly, dividend also will get changed, and to calculate this, first we shall calculate the previous retention ratio and then EPS, assuming that the rate of return on retained earnings is same. Very important this is. Okay. So previous growth rate was 8%. R being 10%, retention ratio is almost the same. Okay. So we find out retention ratio to be 80. Therefore, payout ratio would be 20%. Right? With 20% payout ratio, EPS will be as follows: 25 being the dividend divided by 20%, 125. This now the new EPS would be, right, 40%. Now they're saying that the dividend payout ratio is changing. The due dividend will be 125 into 40, 50. ಅರ್ಥ ಆಯ್ತು ನಿಮ್ಗೆ ಏನಾದರೂ ಇದು? Yes or no? Right? So what they're basically telling is, if there is a change in the payout ratio, then how will you do it? ಅರ್ಥ ಆಯ್ತಾ all of you? So as a balancing figure, ಇದನ್ನ mark it important and solve this compulsorily. The second part of the question. Some compulsory solve this. Okay. Accordingly, new KE will be the same formula, D1 by P0 plus G. That will give me K. Right? All of you understood the second part of the question. As a balancing figure, it is found out. Sana, where are you? Yes. Huh? So I repeat, go through the page number. Question number 8, Allah.
529.
Yeah. Just 1 minute and then I'll exit. Look at this. It is expected that PQR Limited will earn 10%. That means this is my rate of return on retained earnings, and it shall retain 60% of earnings. World, all of you. Here 60% of earnings is retained. Above, what is happening? See, if 10% of retained earnings, see, if you are assuming the 10% will not change, all of you. Return on investment, will it change with the change of the dividend payout ratio? No. So R, if I assume it to be 10% and if growth rate is 8%, then what is my payout ratio? ಅರ್ಥ ಆಯ್ತಾ ನಿಮಗೆ? Retention ratio you find out. Got it, all of you? So earlier, if retention ratio, whatever you find out, you dividend divided by my dividend payout ratio will give me my earnings into my new retention ratio. You do dividend payout ratio, you will get the new dividend, and then you use the B into R formula and then find out what the new K is. ಅರ್ಥ ಆಯ್ತಾ ಏನಾದರೂ? So basically what I'm doing is simple. Okay, in the first instance they've given you the rate, that is 10%. Clear, all of you? Rate is given and dividend is given. Right? First one K you find out. Second instance ಅಲ್ಲಿ what additional information they're given? They're giving you retention ratio, which was not given in the first one. Right? Growth rate was given directly. Now if growth rate is 8% and rate of return is 10%, then what is my dividend retention ratio? ಅರ್ಥ ಆಯ್ತಾ? So you find out if retention ratio is so much and dividend is 25, what is my earnings? Earnings will be same in the second also. Multiply into the retention ratio, you get the dividend. Once you dividend, you find out the dividend, you find out what K is. I hope now you understood, Sana. Yes.
Yeah.
That's it. All right. Thank you, everybody. Bye, all of you. I'll meet you all tomorrow in the revision session.